Thank you. Good morning, everybody. Welcome to Diversified Umbrella Fund's investment report back. Just thought I'd give you a little bit of background. Both funds are actually managed by boards of trustees, 5 trustees in total, 4 of whom are independent of any service providers. As a board, we look to our independence from our service providers, and even though one trustee is Mr. Tennant, the majority are independent, therefore we can outvote him. And we think this is quite a significant thing for an umbrella fund because, as you probably know, most umbrella funds have either 50% sponsor trustees or even more than 50% sponsor trustees, which I think is not how it should be, but that's my personal view. Anyway, apart from also introducing the fund investment advisors who are here, I'd like to announce that the funds have negotiated a change to the investment management fees. Up to 31st of March, Horizon, that's Johan and Henry, received 0.25% of assets as a management fee. This has now been reduced to 0.15% of assets, effective the 1st of April 2022, which has allowed the other 0.1% to become payable to the servicing broker who puts the business in the fund. Okay, there are some conditions, and it must be noted that fees are exclusive of that. Fees are calculated on the previous month's investment value and paid between the 7th and the 10th of the following month. Fees are not payable on any assets underlying any home loans, as the member is effectively investing his own money in the fund and becoming the investment manager for that amount of money. Fees are not payable in respect of inactive members where contributions are not being received by the fund. Fees are only payable where the servicing broker has signed a contract agreeing to the fee basis being payable. No backdating of the fees is accepted. I hope that's of some interest to the brokers who support this fund. I think it helps you, and I hope it helps the fund grow, because the point really of any umbrella fund is to grow to a size where it becomes relatively inexpensive to administer. As you can appreciate, a small fund still has to carry all the static costs of audits and valuation work and FSCA levies, which seem to go up astronomically every year. So the bigger the fund is, the more that cost is spread. Okay, without further ado, I'd like to introduce Johan Werter and Henry Nienaber, our investment advisors. And Johan is going to talk to you about what's going on in the world and how we're going to make millions out of your investments. Thank you.
All right, thank you very much for the opportunity to talk to you. We have come across the way we advised 2 boards of trustees a number of years ago, around about 12, 13 years ago, in starting to see where we attended trustee meetings that often there are actuaries, fund managers, analysts that come and present to board of trustees. And there was one specific trustee after one of the meetings that came to us and he said to us, if you bring another guy showing a lot of charts to us and it tells us a lot of stuff which we don't understand and or can't comprehend, then we are going to punch you up. And he was much bigger than I am, believe it or not. And I listened to what he said. And Henry and I subsequently came to the idea of starting to generate a picture for people. Because trustees are also human. Humans obviously come from a variety of background, and not everybody has got the same in-depth knowledge on investment. So it made sense to us that we rather generate a storyline regarding the macro environment, the political environment, bring it down to economic implications, and then take the economic implications down to fund level. Then we, next to that, we go and visit the fund managers themselves. So recently, Henry and I flew down to Cape Town as an example. We saw 3 different fund managers. Amongst others, we saw Signia. It was just as a point of interest. We saw the chief investment officers. They are two guys doing the investment decision making at the top at Signia, managing just over 300 billion rand currently. It's grown incredibly. But what's important to us is that we speak to face to those decision makers. Initially, when we started up with this process, it was quite difficult because we still had legislation in place where brokers or advisors were taken down to Cape Town, and we would wined and dined, and you stayed at the 12 Apostles and you could select any wine you wanted to. And that caused a bit of a discord, and it caused a bit of a conflict, in a sense that people started to make decisions based on external circumstances and not whether the fund manager actually does a good job or not. So we were very happy that the conflict of interest legislation came into play, and that allowed us to further extrapolate the way that we work. We therefore do a number of due diligences with a number of fund managers directly. We always speak to the fund manager themselves, but if there are specific technical areas that we want to cover, then we ask for that prior to us doing the due diligence. And in doing that, we can ask very specific questions from a manager. During lockdown, it was quite tough because of the inability to ask questions at random. Because if you're online, usually people prepare a presentation, and you can't really ask what you really want to ask. And with that now starting to dissipate, we're quite happy about it, because now we can sit in front of a guy and he can make a comment and we can stop him and ask please or her and ask, what do you mean by that? So what we do with all these due diligences, as an example, Henry and I did 24 due diligences the last month. So we keep ourselves relatively busy to try and understand what the fund manager's views are. Our reasoning behind it when we started out with the process was to say that if we see 24 guys next to each other, we see them from this side, but they only have one process and philosophy which they follow. So the next guy, so the next guy, so the next guy. So in doing an holistic view on it, we see what the market direction is, and we can follow that golden thread. So when we go back to the Board of Trustees and the likes of a Signia as an example, we can start asking the questions from that perspective. Are you guys doing the same as what the rest of the market is doing? So we're looking for consensus. And consensus, if you sit with a bunch of actuaries, CAs, CFAs, engineers, MBAs, with a lot of experience, and they do all the research in all the different sectors of the market itself, on bonds, on cash property, etc., then there's a high likelihood that he knows more than I do. So if I think that I'm arrogant enough to know more than these guys all thrown together, it's a long shot. So what we try and do is not to say that we know everything, but we try and understand whether the fund manager understands the logic behind what's happening out there in the world, and do they bring it back to the funds? Because if you keep on over-investing in the likes of Naspers and Prosus, when we know there's a China crisis going on the edutech sector, and prior to that, then there's a concern to us, and we start asking hard questions to the fund manager. Just a point of interest, Signia has known us for quite some time now, and with those senior people, it was quite interesting for us that Henry and I sat there, we have this discussion with them, and when we finished with our inputs and the questions that we have, they asked us as well, who do we think are the good smaller fund managers out there? Because they don't get to all the guys, and then we could give our input to it. So although we're a relatively small outfit, I think the process and the structure that we followed do protect the client. But it also, to us, it's very important that the Board of Trustees are protected. So the investment policy statement, which Nick was a big driver behind, we drew up in conjunction with him based on PF 130. So we try and base our advice process and the arena in which the Board of Trustees function on legislation. So for my sins, I've got a legal background as well, and it helps Henry and myself to just construct an IPS from something which is a reality. Out there in the universe, you'll find that a lot of IPSs of a funds still consists of a one-pager. And that does not give you the real process of what needs to be followed regarding investment. So we think that we've done quite a good job on that, not being arrogant, but I think being basic, and to revert back to basics to make sure that we do the right things. So in doing that, I'm going to attempt to sketch to you the current environment and typically what we'll be looking at to see what the implications in the world are on our environment. Ironically, at the moment, although the guys want to set up a 22 million flagpole, which is to me still mind-boggling how it gets to that, there's not much from a South African perspective at the moment, besides the shots that we're taking currently from an international inflation environment driven by oil and retail spend in the US, etc. So I'm going to sketch that as best I possibly can. And I'm just seeing how I need to manage this. Oops, sorry. Kan ek kom op hier? Alright, so the process flow that we always follow is to look at the international side first, because we need to understand that all of us live in the world. So you can't divest yourself from what's happening elsewhere in the world. One has to take into consideration what's happening on the outside and what the actual implication on the economy worldwide is, and then bring it down to South Africa, then bring it down to fund level. And if we see that line running through, we know that the fund manager is on the right track. But if there are certain things that we don't pick up from them, which we see in our research, then there's red flags coming up. And then we'll redo the diligence those guys to make sure what's the reasoning behind it. Maybe they've got a different and a better way of looking at things, and we can't eradicate that. So I'm looking at it internationally, locally, and then I'll just give a summary on it. So this is a combination slide, basically referring to inflation and COVID, because those two run hand in hand. There's a slide coming up, but I'm not going to bore you with the content of it. It'll be mailed to you so you can read through it at leisure. I'm going to try and just encapsulate what this slide tells us. The first thing is COVID happened to us all in 2020. We were all put in hard lockdown. We all remember that still. It's very recent. It caused a lot of negatives in the market over a short space of time. The reality of it all was when we did a lot of due diligence in that period that all the fund managers were in agreement that the recovery would be relatively quickly. So we didn't advise in any way to the board that we should move out from our mandates, but rather stick out and wait until, as the fund manager put their ducks in a row, we get out of the hole in a nice and consistent manner. Not knee-jerk reaction. That's definitely not what we want to do and what we strive to do with the fund. So the COVID thing caused something interesting. It triggered our minds in saying, all right, this must change world economy. But how? And nobody knew at that point in time how it's going to change world economy. But it's actually only starting to kick in now, ironically. So just put yourself in a position. You're an American. COVID came. They were put under hard lockdown. A lot of those people left employment, mostly medium-sized to smaller-sized companies, were informed that they would get government grants. So what did the companies do? They got in an agreement with their employees and said, well, you're going to be paid, but you're going to be paid by government. Our biggest expense on our budget is salaries. So we all get fired. So you guys get fired, you go and sit at home, you get your payment from the government, and we lock our doors. When COVID restrictions lift eventually, we can unlock our doors, you get re-employed. And that's exactly what happened. So we saw it in the unemployment figures, which ran up to 20%. Most of you would remember that. And obviously you get doom prophets, and they were saying this is the end of the world. We always get the doom prophets. Those are the guys that run the market far over its upward curve and far under its downward curve. Those are the guys that drive sentiment, and we don't want to listen to sentiment per se, because somewhere you're going to get back to your equilibrium. So we saw what was going to happen in the small and medium market, but in the higher employment corporate environment, people were sent home. They started to work from home, similar as we did in South Africa. So what happened then is your expenditure becomes less and less. Your income remains the same. So the guys received their income, paid into their bank accounts on a weekly basis in the US, monthly sometimes, and they start building up cash in their personal bank accounts. In addition to that, government paid all of those people a government grant as well. That pays into your bank account. It extrapolates the bank account. People started then to buy with Amazon. So you don't have to believe me. Go and look on Bloomberg or whatever system you utilize to go and see what happened with Amazon's share price when COVID hit. It went it took a huge upward spiral. And as it went up, there was some kind of a saturation point, and it started to move sideways. And as restrictions was lifted, Amazon's price went this way. It went south again. You can go and compare that to Walmart. Exactly the inverse happened there. So Walmart, when lockdown hit, the Walmart stores took a hammering, obviously. And the share price went like this. Then it went sideways as it got to a saturation point, and when it opened, Walmart's price went like this. So it's interesting to see that that's an actual fact. It's something that has happened. So yesterday we had another due diligence, and we were shown the number, the amount of money that people saved up during the COVID phase. $2.3 trillion was saved up. So again, don't believe me, rather look at the figures. So if you've got an excess of $2.3 trillion and you have now opened up from COVID restrictions, where are people going? According to Walmart figures, back to the shops. So what do you do when you go into the shops? And it's open season. If you've got cash in your bank account, you buy more stuff than what you would need. So that is currently causing a huge retail consumer inflation in the US. Now, Mr. Powell, he tries to show that in his announcements, although they're increasing interest rates to curb that inflation level, it is not clear to them when this 2.3 trillion spend is going to run out. We know that that's really the inflation that's running the US, because they've got a demand inflation, where we've got a push inflation regarding oil prices, obviously upping the petrol prices, and then causes the redistribution of food via trucks and etc. in South Africa to pick up prices. So our inflation is driven by the oil price. And it's unfortunate because we are in a position where our Eskom prices are high, oil prices are high, everything just goes up. And the guys with the vehicles, you'll know that the people that are looking to buy vehicles currently, it's so difficult to do that, especially the younger guys. It's so difficult to get a vehicle quick enough that you go onto a waiting list. If you're lucky, you get one quickly, but it's really a waiting game. So that COVID, we're actually in a long COVID, if you want to call it that, regarding economic principles. And that's really pushing up inflation significantly. The same thing happened it's currently at about 8.5 in the US. the UK inflation rate had shot over 9%. In both those instances, it's at a 40-year high. It's a 40-year high. It's incredible. And for a change, our inflation is still set in April at 5.9%, which is now lower than the US and the UK. And as well, the Eurozone is at 7.4% on average inflation. So currently our inflation is running at quite low figures. So interestingly enough, then we asked the question, but with our GDP, do we have to follow suit? And when Mr. Powell increases the rates and the central banks all over the world increases interest rates, do we really have to follow? And then we got a good answer from a couple of managers that said to us, yes, we do. Because if we don't, we are seen as a juvenile investment destination. So people don't want to invest with us if they don't see we follow the rest of the world. So it's a bit of a catch-22 because we don't really have the economic growth to say that the up of interest rates are good. But in the same instance, we have to follow the rest of the world. So that makes it quite difficult. So inflation is the biggest problem we currently experience on the market. So these pullbacks are not something that we think one should be overly scared of. But we'll have to see how it plays out. I unfortunately dropped my glass ball, so I can't see what's going to happen. But in essence, if it plays out the way I sketched it to you, it should be a relatively short period of inflationary drive. And when it comes down, obviously the US will be the first to have to bring down their interest rates. And follow suit will be the UK usually. They're usually about a day after the US. They increase or decrease their rates. And then the Eurozone follows thereafter. And then usually we're then at the back of the bus and we follow suit as well. So COVID is definitely playing a role, but the impact of COVID in the rest of the world is also interesting to look at. So all that stuff that I mentioned to you is really taken up in this slide. And the one thing or two things I can just maybe add to it, but I'll touch on it during the talk in any case, is the oil prices, which I've already alluded to, which Russia was a big talking point initially, but is it really that big a talking point? So we looked at that. Contribution to world GDP from Russia's side is 3.1%, mainly driven by oil and gas and fertilizer. So if you don't want to, luckily we're in winter time, so we don't use a lot of fertilizer, so we don't have to use that. But the oil and the gas production that the Russians brought in over time now do have an impact on the oil price. We do, however, believe that the OPEC countries and the US have got enough oil reserves to actually flood the market again. Why they are not yet doing it is not 100% sure. Mr. Biden has announced 250 million barrels that will be pumped into the system. Unclear when that really will happen or whether it actually did happen already. But prior to the Russians being able to generate oil, the majority of oil comes from the OPEC and US environment. So that is driving inflation as well, specifically in countries like us where we have a push inflation causing our prices to go up. Secondly, COVID in China is something that is a concern. They are at a place where there's a huge increase in COVID cases. The hard lockdown which they did initially is now really not working in their favor, because as soon as they started to open up for international trade, COVID slipped into their borders, and they should have expected this. But like we all know now, the variants that are now doing the round is not as aggressive as the initial Delta variants, as an example. So it seems as if the COVID thing has a definite impact on production in China. We do, however, believe that if you refer back, that China has kept on producing during the first COVID in happenings. So that meant that you built up backlog of goods. and that goods are being exported. The unfortunate part of it currently is that the harbors are influenced negatively by the lockdowns in China. So they can't export as aggressively as they have done prior to COVID. Why we say that China would not necessarily stop in the production is something which Xi Jinping mentioned when the edutech bubble burst in China. And we didn't immediately understand, and all the markets took a hammering because of the edutech sector, which was much more regulated in China. But then Xi Jinping, I was privileged enough to listen to the speech. I didn't listen to it in China. I rather used the translation. My Chinese isn't that good. But the principle that he discussed is that they don't want to stop with GDP development. Now, if you just look at their population, it's at 1.4 billion people. We can't comprehend that. It's a huge amount of people. We're sitting at possibly 60 million, which we are also very unsure of because our census wasn't as effective, I think, as what is professed on the news stations. But there's a huge drive to get everybody on the same level because the Chinese implements communism. And that's the problem that developed over the last 40 years, where they have at an average GDP of between 8 and 10% per year for 40 years. Initially, when they started out 40 years, with the IP that the Americans planted in China, and which they duplicated over time, the base of their economic environment was small. But if you keep on growing each year at that rate, 40 years later, an 8% GDP growth on such a huge economy is massive. So Xi Jinping indicated that they're not unhappy about the education, they're just unhappy that everybody cannot get the same education because of their communism system. So the people that went from poverty into a middle class environment and to a rich environment could now afford to get additional education, to buy additional education online for their children. And the Chinese government says that's an unfair situation in a communist environment. Again, we won't understand it because we've got freedom of choice, and so most of the rest of the world, but that's not how the Chinese work. So they said, therefore, we need to clamp down on education. And then when we've clamped down enough, that education, the technical side or technological side in China should turn around and there should be a run again. So we have started to ask that question to the fund managers as well, in whether they are starting to look at Tencent again. Are they looking at Prosus? Are they looking at Naspers? And right through the board, the answer is yes. Some guys are still very cautious because they don't know if there's still a little bit of a pullback on the technological side in China and then only a recovery. But they do foresee over the medium to longer term that there'll be a good recovery on the tech side. So can you already see from just that perspective that it's important for us to understand that bigger picture? Because if a guy brings in Naspers now, we don't want to make a deduction on thumbsuck, but rather understand why that person would bring it in. So in that, a number of our managers brought down Naspers Prosus allocations quite aggressively over time, and that worked very well in our favor just in this recent time. So quite happy that COVID is looked at a fair way, but we still a bit uncomfortable about China and what the real effect of COVID is on China. But now, and therefore on the rest of the world, but now we also know that COVID plays out relatively quickly. So that COVID in China should play out relatively quickly. Only time will tell now. So we're not unhappy about the markets where it is. We would not like it to be there, but we understand why it is at the levels where it is. So you can scroll through the COVID implications as well. Just a couple of interesting pointers. The death rate currently is, or the deaths currently is at 5,218 in China, which is not really trustworthy. We don't know whether that's the real facts. With 1.1 million cases currently, That causes panic in the markets and it brings down the markets. But it could be as quick as what we've experienced COVID, so not overly concerned. But it is one of the three factors that is prevalent today, and we need to take cognizance of that and understand how it will play out. And it's important because when one sees, from our perspective, when we talk to the Board of Trustees, we must explain to them why we don't want to make immediate moves or whether we want to make immediate moves. So we have presented in the past where we felt uncomfortable with certain managers. We would put a red flag on that and keep on due diligencing. And finally, if need be, we'll remove such a manager, or not us, the board will make a decision, but we'll suggest to remove a manager, if need be. We're not going to go into a knee-jerk battle. The COVID, a definite issue. And then for all the ladies, there's a wonderful guy. I hear he's very, very handsome and very giving. He just gives a lot of grief. So that's all he does at the moment. The Russian thing is an interesting thing which we started to follow. And in following it, we said, but what is this really? The markets were adversely affected when he deployed troops. You would have seen it on your graphs in the past. It was unnecessarily aggressively taken up in the markets, but it did happen. With that small contribution to world GDP, as I explained, with the oil production that they have and they have to distribute it to generate further cash, they are slowly but certainly winding down into a cash problem. I did pick up yesterday that China and Russia is now in negotiation for China to buy oil from Russia. According to China, it is a strategic move from their side, which we do not yet know what that means. It could be just to keep their economy going, so we'll see how that plays out, but it's something we're watching. So I specifically added the Russian situation last in line on those three issues, because inflation is the most important one hitting us currently. COVID is still prevalent, so it's the second one, and Russia is slowly but certainly fizzling out. But what we did for you, and this you can read in your own time, we went back to World War II. And we started to look at the World War II environment and what happened thereafter. And if you look at the current situation, it's definitely something that still spends or is an outflow from World War II, the Cold War. And the Cold War in essence was NATO that was set up just after the Cold War, and the Warsaw Pact set up the USSR, of which the Ukraine was part of. So in the early 90s, the Cold War ended because Russia ran out of money to sustain it. And just as a pause, Cold War means both of these guys have got nukes. So the US have got a huge amount of nukes, and Russia has got a huge amount of nukes. So both of these guys sit with, it's like two very aggressive dogs, but a nice fence in between, and barking at each other and jumping against the wire. But nobody is willing to press that red button. Because if that red button is pressed, you will see a seizure of the world. And that's what the Cold War is really about. So the outflow of the Cold War was that Russia then tried to get closer to the US. So they went into countries like South Korea, and then the US retaliated. Just keep that in mind as to the end of this point. US retaliated, sending troops into South Korea. After a while, that war fizzled away. Then the Russians went into Vietnam. So all of us have seen Vietnam movies somewhere down the line. So they go into Vietnam, the US retaliates, and they send forces into Vietnam. Soon the war fizzles away. Then Afghanistan. The Russians tried the Afghanistan route. And then again, troops were sent into Afghanistan. And again, that war fizzled away. So the Cold War, in essence, still hasn't stopped. And this is part of that, because what NATO did, there's a nice graph on Wikipedia. If you go and search Cold War and go onto Wikipedia, it shows you the expansion of NATO, which is basically a military program with all the Western countries participating. And I see Finland and Denmark and them have joined now as well, because they're obviously next to Russia. So it is a concern to them. Now, NATO has expanded into Europe at quite a rate over the years from the start of, or the end of the World War. As you all know, the Berlin Wall that came down as well. A lot of the young guys wouldn't have been born then, but it was a big event when it happened. And it kept on moving into Europe. So in 2014, the new government in Ukraine was elected, and they are pro the Eurozone, so the European Union. And when the European Union allowed them to be part of them, that allowed for open borders. So Schengen visas status was given to the Ukraine in 2017. That meant that there was free movement between borders from the Ukraine into the rest of Europe. And they like it because they want to be part of Europe. So obviously Putin didn't like it, and if you recall in 2014 he went and sieged Crimea and took over Crimea to be a strategic vantage point for exports. And now the Ukraine issue has become a problem because NATO troops have started to infiltrate Ukraine and have started to move towards the borders of Ukraine. If you look on the map, the world map, you'll see that the Ukraine borders are relatively close to Moscow. So it's in firing range for long-range nuclear missiles. And is it therefore unfair for Putin to retaliate? I don't talk the guy right. I think he's a weird character and maybe a lunatic in that. But it doesn't seem illogical that he wanted to stop that further development of NATO. Because it's exactly the same what America did when they went into South Korea, Vietnam and Afghanistan. So the principles remain the same. And therefore, it's in essence, one can say, still the red buttons isn't pushed. And therefore, did the Cold War really end in 1991? No, we don't think so. So that war will probably rage for the rest of our lives. One of our clients asked us, is this war going to end? When is it going to end? And I said, maybe in 2,000 years, probably. And I don't think it will ever end. And then I looked at a number of documentaries about the Ukraine. And it's interesting to look there, where the Cossacks in the 1200s already invaded the Ukraine, and there was wars being raging. The wars have been raging ever since. And if you look at it from those glasses, and then you see the images from the likes of a CNN, and where the maternity hospital was so-called bombed, then if you were just finely tuned, you would see that there's no windows in any of those buildings. So it's probably been bombed, but probably 8 years ago. And those windows and stuff that could be attached and moved elsewhere were taken out. So it's very difficult to trust media. So we try to talk to all of these different fund managers to assess better and to understand a bit better regarding the economic implications, because we have to advise the Board of Trustees that we either need to look at more aggressive allocations currently, or we need to just stay calm and follow the mandate which is in place. And by doing that, the research on the total picture, it gives us a better idea of which direction we should go. So yeah, Melanie is going to shout at me. Gee, this thing is sensitive. So the Russian thing is nearly forgotten, but it's definitely still there and an issue on the markets. And then I gave you a full rundown, just explaining you all the different ins and outs and aspects to that war. So you can have a squiz through that and you don't have to go and research it yourself. But it gives you a good idea why Russia was important and why it did have a definite impact on the markets as it is currently. So on the local side, quite quiet in a sense, besides the flagpole, obviously. But to look at those three areas, namely inflation, COVID, and the Russian issue, we have to bring that down to South Africa and say, but what's the actual impact? And the actual impact, which we all feel currently, and we're all going to feel it in June again, is the oil price. And therefore the petrol price. And with the petrol price, as that increases, the transportation of goods becomes more expensive, and our monthly expenditure on groceries increases as well. Also, Eskom is a problem because as we do have load shedding from time to time still, they have to run, making use of the backup systems, making use of oil and diesel. And that costs more. So the cost, again, the push effect to our electricity is coming. We should be aware of it. So hopefully it can play out relatively quickly. The war will add, at that place, it will add good to us, in the sense that the Russian production and delivery of oil and gas can resume, and it should alleviate the oil price, and it should bring down the petrol price as well. When it will happen, nobody knows. As good a guess, yours is as good as mine. But it does push up our inflation, and we have to follow the inflation and interest rate developments as it goes on in the world. We can't get away with it, but there are a couple of things that can help us on the fuel price, like the road accident fund. We firmly believe that it's still part of the state capture environment. And unfortunately, if you set up a lot of attorneys on the outside who submits fraudulent claims to their friends within the RAF, obviously that fizzles out a lot of money there as well. Whilst we are contributing to the RAF when we put in a tank of diesel or petrol. So it's not a good thing to have, and I hope government gets to it relatively quickly. It can alleviate a lot of stress in South Africa. So the international environment on the oil, on the exports, the shipping as an example is a big problem. If you look at a crate, let's say a container which is imported from China as an example. Prior to COVID, the crates or the containers was in the region of about $2,000, $3,000, $4,000 a crate to rent it. And then if you imported goods of about, let's say, $36,000, you can go and do the calculation on the percentage cost which is involved with importing using the container. It shot up to around $12,000 per crate because of the fact that exports slowed down during COVID and the demand kicked it up. So there's a huge demand on crate and a shortage of crates or containers. So if you take that for a small importer, it suddenly adds about, where it was, let's say, at 10-15% of his total cost, it shot up to 30%, 33% of his cost. And that depletes his profit margin. So it makes it difficult for the small investor in the current environment because of these inflationary pushes to do business and to import. The big importer isn't hurt that much because they work on quantity. And therefore the total expenditure did go up, but because of their bigger imports, they have negotiation power, they've got preference, and they can still go on. But it really hurts the small investor, and that's the area where we are, the small business. And that's where we need to grow the economy on the small side. So it has a definite impact. Secondly, Eskom is obviously, I covered it, mentioned it, but just an interesting point was the whole SCOPA meeting, which you probably saw on the news, where one of the directors of Eskom backing the writer's leadership was ousted from that meeting by the chairman of SCOPA. Based on the fact that she presented on the 9 principles which was already implemented by Eskom as part of their 26-point plan. So that just showed that there's a definite implementation and a structure and a plan that Eskom has in play. And they then don't allow you to explain the detail behind it, but rather want to bring politics into the situation. And I was very, very impressed with that lady standing up and telling that oak to get his facts straightened out, because his way of attacking it was pure political. So it was very interesting to see that 2 days later there was an apology issued. So there was a definite backing by government of what Eskom is doing, and I believe that we're moving in the right direction. Also, solar and wind power. I was privileged to be in Cape Town a while back, and we drove there in the Overberg area as well. And I saw all these wind power, turbines that have come up. It's incredible. Similarly, in the Eastern Cape, Carl, I think you were in the Eastern Cape recently. On the Eastern Cape, there's a huge amount of wind power that has come up. The French are developing at a rate of knots the solar cities in the Karoo area, but you still have a problem of linking that to the grid. So you still have to link that to the grid, and it takes time. It took time because we also had to get past legislation. When Cyril announced it, the country had to get past all the unions first. When they got past the unions, then it had to go through Parliament, and finally that was approved. And then your amount of production that can go into the system increased from 10 megawatts at that stage to 200. So slowly but certainly those providers will come onto play. Maintenance is still running at a rate of knots. It's around 6,700 megawatts at any given point in time, which is under maintenance. That means that your maintenance projects have been running for about 2.5 years now. Now remember, people have a short memory. If you look at the Zuma era, the likes of Marcelo Koko, Brian Molefe, Anosh Singh, that was in charge of the Eskom environment, did not do any maintenance for 9+ years. So you can just take your own car. If you don't do maintenance on your vehicle, somewhere it's going to break down. And the same principle applies to Eskom. So they are definitely in the process of keeping on with the maintenance, and they're managing the outing of electricity quite well, I think. They've come to grips in how to do it. Over time, there will be a tipping point that's reached where maintenance is on target again. It's caught up, and you have renewables that feeds the grid as well. That would then allow them at that point in time, probably 2030, 2035, to start implementing nuclear, but at a small rate. So people again forget the past. If you refer back to the nuclear discussions that was on board, we would have sold our country to Russia. Should we have allowed Russia to implement a nuclear station at those levels? So we also would have sold Eskom to the Chinese, because they were close on, and the mining sector as well, they were close on borrowing money from China. Now, if you borrow money from China, the problem is if you don't pay it back at some stage, they own you. If Cyril then came in, gladly, he came in quite before that happened. And then he said, no, we're not going to borrow money from you, but you can buy our bonds. You're welcome to buy our Eskom bonds. And just as a point of interest on that, the fund managers are starting to look quite aggressively at Eskom bonds, believe it or not. The upside is huge on it. And if they go on the trajectory that they are currently, we'll see by December when their year results comes out again. Last year they were already profitable, except for the fact that they had this huge debt burden that hangs on their backs. And that's because of the fact that they gave money to the Guptas to buy the likes of the Ghetto. And that caused this bubble of expenditure or debt that was built up in Eskom. So Eskom is not necessarily at the bad place. We believe that it is salvageable still, and we can get out of this hole. And then obviously COVID in China slows down production, and if that happens, the export slows, goods slows, prices, demand increases, prices go up. So it's got a bad negative cycle. So we hope that the COVID plays out relatively quickly in China. It will have an immediate, very good impact on us. So we'll see how that plays out. And then just our process quickly, all of this stuff, over the last couple of newsletters, those that our clients already would know, we've covered most of these areas in the newsletters over the last couple of months. Just trying to keep you in play of what's happening out there. as best we possibly can. You can obviously not talk about everything. I said to Melanie, if we really have to talk about all the detail, 3 hours would be enough, but we can't sit here with 3 hours. One-on-one conversations would be good. Because there are so many dots that is in play regarding the economy, both internationally and locally, and that has a direct impact on your fundamentals. Often, if you just look at the company per se, if you look at the likes of Apple, or you look at Amazon, or you look at Tesla for that matter, those products are very good. It's very good product. And the company can do very well with normal business. But the demand on the shares has been ridiculously shot up. If you look at Tesla as an example, a year ago, you remember in the board meetings, I showed it to the guys on Bloomberg. It shot up to 900 PE. 900 PE. And people still buy it at those levels. Now, in the investment environment, you guys will know, but the fund managers always say there's another fool that'll buy from you. So it seems like the fools will always be there, and it shoots up the price. Similar to what recently happened on the crypto side, which a lot of hurt was put into the crypto environment. We often advise the board still to keep away from the crypto environment, but as soon as it's accepted as a real currency, then obviously it will become something that one has to bring into the investment environment. So the process is quite simple, which we follow. We try and look at all these aspects. These are just 3 major aspects currently hitting the world economy. 3 major stuff that's hitting the international markets more aggressively than our markets, but it is, we're unfortunately collateral damage in the whole process. And therefore, we need to be sure that we are with the right managers. So if we see chinks in their armory, we will advise the Board of Trustees. We are totally objective. We've got no other interest in it. And our own money is on this fund as well. So I've got a real vested interest myself and Henry for us to make money on it. So yeah, that's our commitment. And then, yeah, just a last summary. The local remains lacquer. Our markets are very, very low priced still. Our PEs are in the single digits. The average PE in South Africa, and your historic PE in South Africa is 14 over the last 100 years. So we're at a good place. The international market is still high. It's still expensive. But what we saw is that there are green shoots. So there are certain companies that do very good business. They don't run with debt. They've got good business models, and they pump out cash. And those people are still good places to invest. So selectively, international investment is still good, but for now, too expensive still. And we still are looking at it, and we'll see how that plays out going forward. But local is still a good place to be. And yeah, we write that report on a monthly basis, obviously. Do our due diligences consistently, and then give feedbacks to the Board of Trustees on this whole picture that I sketched. And based on that, we make a joint decision. So to us, we're part of the board in the sense that we need to act in their favor, and ultimately to you as advisors as well, and to your clients. Because the better we can do this job, the more secure you make your relationship with your clients, and the better business you get flowing from that as well. So Carl and I have been working quite a bit with each other. So he can attest to that. So he takes me along to some of his bigger clients. And yeah, he's generated quite a bit of individual business from that as well. So yeah, thank you, Carl, for supporting us in the way that you do as well, and the fund. And I think there's a lot of scope. Steve and the board obviously did a huge turnaround on the whole Tennant strategy regarding the umbrella fund, and it's starting to get good traction. We took a long time to make people aware of the fact that you have to have an objective advisor on the fund, because in the past you would have the likes of, I can't mention names, but let's say an investment house are the fund manager on the fund, but they are also the asset consultant. And the simple question you can ask to yourself, is that Mr. X going to fire Mr. X if need be? And our simple answer to that is no. You're not going to give away your own business. But from our perspective, if we feel uncomfortable about the manager, we'll put it to the board, and they will make a decision on it, and they'll ask us who do we propose to allocate to now. So we believe that it's a new system coming into play in the EB environment, totally objective. We're remunerated by the fund, and after a lot of negotiation, we agreed on the reduction of our fees and giving it out there to the brokers, because we believe we're all partners in the business. So yeah, thank you for your support, the people that have supported in the past, on behalf of the fund, and we'll keep on doing our job. So yeah, Henry, I don't know if you want to add anything. Thank you so much.